Hey everyone, welcome to another video in the Short Straddle video series. We have already done two videos where in one we have spoken about a different perspective to short straddles, and in the second video we spoke about short straddle exit. So we discussed three criterias when you can exit your short straddle trade, and this is the third video where we are going to discuss about the position sizing. Position sizing is the key element in your risk management. So let me just give you a simple example how position sizing actually influences your trade. So let us say you're driving in a highway in the morning. So generally when you're driving in the morning, your speed would be much higher because everything is clearly visible. But as you start driving in the night, you will naturally reduce the speed. That is because what you see in front is not really clear. So when something is not clear or there is some uncertainty, you generally carry less position or you go at a lesser speed. But when things become more clear, you can increase your speed or also start carrying higher position. So now we are going to discuss under different circumstances how we can increase or reduce our position and how position sizing is going to play an important role in our overall risk management and overall profitability. So now without further ado, let's quickly move on to the screen recording. Hey everyone, welcome to the video. When we talk about position sizing in short straddle, we can mainly talk about position sizing in two aspects. So position sizing as per trade and position sizing as per psychology. So when we talk about position sizing as per trade, so we'll be discussing more or less what kind of positions we should hold based on what trade we enter. And when we talk about position sizing as per psychology, we'll be discussing based on how confident we are feeling to enter a trade, how we can size our positions. So these two will be the broader aspects what we'll be discussing in this video. So now let's quickly get on to position sizing as per trade. So when we talk about trading, we mainly have two kinds. One is positional trading, where we carry positions overnight. So this can be a broader category split. And next one is intraday trading. So in intraday trading, position size does matter, but you also have an opportunity to cut the trade based on M to M. Let's say the market starts moving very violently, you can cut the trade based on M to M, or you can simply keep a stop loss. So there, even if you enter higher positions, it is absolutely okay because you have a chance to cut it. So where does the position size actually matter? Where things are more uncertain. So initially I gave a comparison to driving in the highway. So when things are more clearly visible, you can go at a higher speed. So or when things are less uncertain, you can go at a higher speed. When you talk about intraday, things become less uncertain because you can't see a big gap up or a gap down in intraday, and also the fact that you can cut your trades anytime and also keep a stop loss. But when you go to positional, things start to become really uncertain. So any news can come, global markets can behave in a certain way, and also you can see a big gap up or a big gap down, which can cause you a big loss. You cannot keep stop losses. All these factors make carrying a position overnight or positional trade quite risky. So now let's start off by discussing what is the optimal position sizing we have to do to carry a overnight trade. So whenever you're carrying overnight trade, the biggest risk what you have is of a big gap up or a big gap down. So what if you see a gap up of more than 5% or more than 10%? That is what most traders are afraid of. And that is why it is always important to make sure that you size your position right. It just takes one single trade to destroy your entire career. So whatever you have done maybe in the course of 1.5, 2 years can go completely for a toss if there's a 10% gap up, right? So that's the reason making sure how much you should have or how much quantity you should carry overnight is something really important. So first we'll start off by understanding what is the kind of gap up or gap down we can expect. So out of 1300 days, you can see majority of the days the gap up or gap down is within 4%, right? So plus or minus 4%. So around 7 days on this side and almost around 5 days on this side, that is close to around 12 days out of 1300 days, we have seen a gap up or a gap down more than 4%. So we have a probability of close to around 1%. So there is only a 1% chance. So that means out of 100 days, there can be one day where we might open with a gap of more than 4%. So 99% of the times we will be opening with a gap of lesser than 4%. So out of the past 1300 days, never once you have seen a gap up or a gap down more than 10%. So we have also considered the COVID time where VIX was almost around 80. Even then, you haven't seen a gap of more than 10%. So you know for a fact that most likely a gap of more than 10% is very unlikely because we have also considered a black swan event. And we also know for a fact that 99% of the times the market will end up opening lesser than plus or minus 4%. So now for overnight trades, we'll position ourselves in a way where even if there's a 15 to 20% gap up, right? So if let's say tomorrow there is sudden fall of 15% in index, our loss shouldn't exceed 10% of the capital. And for that, all we have to do is simply buy a hedge position for OTM. So I will open the strategy builder on Stockmark and just show you how you can position yourself. But what I would suggest is have a thumb rule that for every 5 lakh of capital, you end up carrying one lot overnight position. If you have something like say 50 lakh capital, you can carry anywhere around 10 to 12 lots overnight position. So this should be the kind of position size you must be having. So now let's quickly go to the strategy builder on Stockmark and see how exactly that would look. On a strategy builder, when I create a short straddle, so Bank Nifty right now is trading around 44,000. So if I create a 44,000 short straddle, the margin requirement is around 1.71 lakh. But what I suggested is to carry one lot for every 5 lakh. So right now I have carried one lot and I am only hedging for a black swan event. So I need not buy my hedges at break even. So that is not at all required. So I would be more or less going and buying a small penny option trading around 5 rupees. And this side, let's go and buy one lot of a small penny option, maybe trading around 5 rupees or 6 rupees. The moment I end up buying these penny options, my maximum loss is now restricted to 10%. So now I don't have to fear about a big gap up or a gap down. I know 99% of the times the gap up is going to be well within 4%. So let's say on Monday, the market goes up by almost around 3% and goes to 45,000. Even then, my loss is going to be around 2.5% of my capital. So it is not so easy to actually lose if you have controlled position size, right? So most likely you're not even going to see a big gap up of more than 1%. So more than 70 to 80% of the times, the gap up is going to be well within 1%. In these hedge options, which you would have purchased, wouldn't have lost much at all. So generally what we do when we trade is we follow this simple thumb rule, 5 lakh one lot. We purchase the hedge positions so we don't have to worry about a big gap up or a gap down. So we already discussed that trading can be divided into intraday and positional. All we did right now is discuss the positional aspect. Irrespective of which contract you're trading, Nifty or Fin Nifty or Bank Nifty, position yourself in a way where even with a 10% or a 15 or even 20% gap down, your loss does not exceed more than 10% of your capital. Once that is done, right? So now we'll see how we can convert that into an intraday trade. So I'm going to now explain how actually I do it in real time trading. So if I am taking a position, how exactly I would convert my positional trade into intraday trade. So currently I am trading with a 50 lakh account and I generally carry anywhere around 250 to 300 quantity of Bank Nifty positional trade. So right after the open, so immediately after the market opens around 916, 917 itself, the first thing what we would be doing is cut the hedges. So we do not want to carry the hedges even during intraday because first of all those hedges are mainly for black swan event and very hardly you can get any black swan event in intraday, and even in such cases you can cut the trade anytime. So these hedges which are 2000 points away are hardly going to make any difference to your trade. So let us say I had carried a 44,000 short straddle. So as soon as the market opens, I will be cutting my hedges. So what I have done here is very simply carried a 1500 point away hedge in put and call on an intraday basis. So the condition is I'm entering at 916 and exiting at 330. So you can see right over here. So overall, you would have lost close to around 2 lakh just with one lot repeating this over 4 years. And when you look at the months, almost all the months you have ended up in a loss. So this clearly shows in the long run, hedging intraday is not really a great option because you will end up losing with your hedge legs. So a better option would be very simply end up cutting your trades small. So it doesn't matter if you have higher quantity, you always can keep a stop loss and cut your trades at the right time. And you can see from the day it started till today, this particular idea of buying a hedge is still running in a drawdown. So what is the second step I would be doing? I would be doubling my quantity for intraday. So if I have close to around 250, 300 quantity, intraday I would be trading around 500 to 600 quantity naked. So now I'll be doing multiple adjustments to my trade on an intraday basis. And as we come towards 315, so as we approach 315, I'll again add back the hedge legs and I'll be reducing the quantity. So it is a very simple transition. Let's say I have a 44,000 CEPE or a short straddle. As soon as the market opens, I'll cut the hedges, increase the quantity, do any kind of trade managements like adjustment or shifting or whatever it is. And then as we approach 315, I will take a position and add the hedge legs and also end up reducing the quantity back to around 250, 300. And next day, again, I will cut the hedges, increase the quantity, and towards the end, again, I'll reduce the quantity and add the hedges. So this is something which we do it over and over again in a loop. So this has actually helped us maintain a very good balance in our trade. So this is how we maneuver our position sizing from intraday to positional. Intraday, you can always increase the position because of the lesser risk and you can try to increase your profitability, right? So this is with the trading aspect. In the very first, we discussed two aspects. One is trading and the other aspect is nothing but the psychology. With respect to psychology, things become much simpler. So, whenever you talk about trading, it is highly dependent on your confidence level. Sometimes you will be in a winning streak. So, whatever you are doing, things will be going well. But in some other times, you will actually go into such a phase, whichever trade you take, whenever you end up adjusting, you will actually get into a mess. So, here you will be actually getting hit in terms of your psychology. And that is where you have to know when to reduce your quantity of trading. So things are going to go up, things are going to go down in trading. It is as volatile as stock market. Even our emotions are going to go up, down. Even our confidence is going to go up and down. So it is always important to maintain a balance to see when things are getting uncertain. So always go back to the first example when you're not getting clarity on what you're doing, you're not getting clarity on what is happening. So that is when you reduce your speed or reduce your quantity. So here you can do a very simple exercise. In the previous week or in the previous 10 days, if you are able to gauge the market properly and things have gone as per your view, so you're able to trade right. So in that case, it is going quite well. So you do not have to do anything with your quantity. So do not try to increase the quantity, just stick to the quantity you are trading with. So now if things are not going as per your view, so let's say you take a trade, market ends up going higher, then immediately reverses. So you will be scared looking at the M2M. As soon as let's say an M2M hits 5,000, you will start to get scared. You will be afraid. Okay, so again, I don't want to go to loss today, so I'll just end up cutting my trades. The most simple thing what you can do here is reduce your position, if not by half, even by 60 to 70%. So this is our equity curve from 2021 April. So you can see as we approached October, so this is the time of October 2021 and this is March 2022. So you can see there is absolutely no growth in the account. So we hit a standstill point right over here. So no matter what we were doing, the account was actually not growing at all, right? So here we had huge issues with our psychology. We weren't able to get into good frame of mind. So that is when the simple trick all we had to do was reduce our position size so we do not end up reacting to everything. So what happens in such cases is you will be very low on confidence. And whenever the market swings, you feel that as soon as you go to red, you're doing things wrong. Okay, you want to get out of it. Something has to be done, or you have to react in a way where you end up adjusting the trade or you end up moving the trade, right? So you do not want to see big M2M swings at all. So that is when we actually reduced our quantity almost by close to around 50 to 60% during this point. And that's when we slowly started to see improvement in our positions, right? So we weren't reacting the way we used to, because so let's say on a 100 quantity, the market has to move 50 points for you to lose 5,000 rupees. But what if your quantity is just 25? But what if your quantity is just 25? The market has to move 200 points for you to lose around 5,000 rupees. So it is not the matter of making profit. So forget about making profit during such phases. All you have to do is get back your confidence. And once your confidence is back, you can see what exactly will end up happening. You can go back to your old quantity or you can go back to your old position sizing, and then you're going to zoom. So this was a bad phase, and this is my personal experience, and that's the reason I wanted to divide this entire video into trade aspect and psychology aspect. So I have covered both as to how exactly you can position yourself. To summarize the entire video, just when you're carrying positions overnight, have a thumb rule 5 lakh per lot, and even in the worst case, you shouldn't be losing more than 10%. Intraday, you can cut your hedges and you can increase your quantity because you can place stop losses. And coming to the psychology aspect of it, so if you're confident, if your days are going well, then continue with your normal quantity. If your trading days are not going well, then simply reduce your quantity to gain back the confidence. And once your confidence is back, you can go back to your normal quantity. This is the summary of the entire video. And with this, we also come to the end of this video. And I hope you found this video informative. If so, then do not forget to hit the like button, share this video, and subscribe to my channel. Thank you so much for joining.